Carhelpout.com. It's the convenience.
Hello and welcome. Today we are tackling a question that troubles millions. It is a financial crossroads many of us face after buying a car. The big question is this: should you stop saving money to pay off your car loan faster, or should you continue to build your savings while making your regular monthly car payments? This decision can feel overwhelming. There is so much conflicting advice out there. Some people say, throw every extra dollar at that car loan. They believe debt is an emergency that must be eliminated immediately. Others say, keep saving, no matter what. They argue cash on hand for emergencies is most important. Without a safety net, unexpected events like a job loss or a medical bill could send you into a financial tailspin. This debate creates confusion and stress. You might feel stuck, unsure which path leads to financial peace. The fear of making the wrong choice can be paralyzing. Doing nothing is often the worst option. In this guide, we will clear up that confusion. We use a simple framework called myth versus money. It helps challenge common finance beliefs that sound good, but don't always hold up. We will look at the myth that you must always stop saving to attack car debt. Then we will contrast that myth with the actual numbers and financial facts. We will explore interest rates, savings, and what really moves the needle for your financial well-being. Our promise: clear facts, simple examples, practical tips, no complicated jargon or confusing theories. Just the information you need to make a smart, informed decision for your situation. By the end, you'll understand the pros and cons of each choice. You'll feel confident to create a plan that aligns with your goals, paying off your car early, building up your savings, or finding a smart balance between the two. So what exactly will you learn as we move through this guide? We will break down this complex decision into simple, manageable steps. First, we will help you understand when it makes the most sense to prioritize saving money. We will talk about the importance of having a fully funded emergency fund. What a fully funded emergency fund looks like. Job instability. Upcoming large expenses. Having cash on hand is far more critical than paying a little extra on a car loan in those cases. You need a buffer between you and life's unexpected events. Next, we will explore the other side of the coin. If you're struggling to come up with cash for an emergency auto repair, you're not alone. That's why auto car repair loans offer a convenient way to gain quick access to the money you need when an emergency pops up. With loans up to $2,500 to $5,000. Visit carhelpout.com/repair loan to get started today. Don't forget, if you ever need to sell your house fast and as-is condition anywhere in the U.S., either to stop foreclosure, avoid county tax auction, or unwanted house, go to boracina.com/carhelpout and get a relief under house burden. Don't forget, if your local small business or good service website needs more traffic exposure from Google, Yahoo, Bing, and other search engines, go to carhelpout.com/SEO. They can help you when it comes to local SEO and online digital marketing service consulting. Scenarios where prioritizing extra payments on your car loan is the smarter move. It often depends on your loan's interest rate. A high-interest loan can drain your finances and cost thousands in interest. We'll show you how to calculate exactly how much you could save by paying it off faster, being upside down on your loan, owing more than the car is worth, and why that matters. Finally, practical, actionable car buying strategies. Get a good deal in the first place. Dealer-tested tips to navigate the car buying process with confidence. How to negotiate the purchase price effectively. How to understand and compare financing offers. Why getting pre-approved by your bank or credit union helps. How to handle trade-ins. How to avoid costly add-ons. By the time you finish, you'll have a complete roadmap. Know how to assess your income. Know how to assess your debts. Know how to assess your savings. Understand the math behind your car loan. Understand the math behind your savings accounts. Most importantly, you'll have the tools and confidence to choose the best path for you and your family. This isn't a one-size-fits-all answer. It's about building a personalized plan that leads to financial stability and peace of mind. There's a very common piece of financial advice that gets repeated over and over again. It has become a kind of myth, a rule that many people follow without question. The myth is this: when you have debt, especially a car loan, you must stop everything else and focus solely on paying it off. Pause all contributions to your savings accounts. Pause contributions to your retirement funds. Pause contributions to any other financial goals. Every single extra dollar should be thrown directly at that car loan. This idea is rooted in a deep-seated belief that all debt is bad and must be eliminated at all costs. Debt does cost you money in the form of interest. The longer you carry the debt, the more interest you will pay. Paying it off quickly seems like the most logical way to save money. Proponents speak with great passion and conviction. They paint debt as a monster eating your financial future. They say you can't build wealth until you're completely debt-free. But this single-minded approach has a major flaw. It ignores the other side of your financial life, the need for a safety net. By stopping all savings, you leave yourself vulnerable. Life is unpredictable. Cars break down. Furnaces quit in winter. Unexpected medical bills appear. Without savings, how will you pay? You'll likely have to take on more debt, often at much higher interest, like a credit card. That creates a vicious cycle of debt. We must challenge this myth. It's not simply good savings versus bad debt. The reality is nuanced. A car loan is a tool. Saving is a tool. The question, how to use these tools together for your situation. Blindly stopping all saving is risky. It's like building a house and only focusing on the roof, not the foundation. Without a savings foundation, a financial storm can make the whole thing collapse. To make a smart decision, we first need to understand the basic terms we are working with. Let's start with savings. When we talk about savings, we are not just talking about any money you have left over at the end of the month. We are talking about money you intentionally set aside for future goals or needs. The most critical type of savings is your emergency fund. This is not an investment account. It is your financial safety net. It is a stash of cash easily accessible in a simple savings account that is there to cover unexpected expenses and protect you from going into debt when life happens. It is your buffer against chaos. The size of your emergency fund is crucial. A common rule of thumb is to have 3 to 6 months' worth of essential living expenses saved up. This would include things like rent or mortgage, utilities, food, transportation, insurance premiums. It is the bare minimum you need to survive if you were to lose your source of income. Having this fund in place provides incredible peace of mind. It means a surprise car repair, a sudden job loss, does not have to become a full-blown financial catastrophe. Instead, it becomes a manageable inconvenience because you have prepared for it ahead of time. This fund is your first line of defense. Now let's look at the other side of the equation. The car loan. When you take out a loan, you receive a lump sum of money to buy the car. This amount is called the principal. You agree to pay back this principal over a set period known as the loan term. But you do not just pay back the principal. You also have to pay interest, which is the fee the lender charges you for borrowing their money. Your monthly payment is made up of a portion that goes toward the principal and a portion that goes toward the interest. At the beginning of the loan, a larger part of your payment goes to interest. Understanding these components is the key to managing your debt effectively. The principal is the core amount you owe. The interest is the cost of borrowing. The term is how long you have to pay it back. Your goal with any loan is to pay as little interest as possible over the life of the loan. Paying extra on your loan can help you achieve this, as any extra payment you make usually goes directly toward reducing the principal balance. This, in turn, reduces the total amount of interest you will pay over time. But we must always weigh this against the security that an emergency fund provides. Section 3. Understanding interest rates, APR, and how it works. When you get a car loan, the most important number to pay attention to is the annual percentage rate, or APR. Many people confuse the interest rate with the APR, but they are slightly different. The interest rate is simply the cost of borrowing the principal amount. The APR, however, gives you a more complete picture of the loan's cost. It includes the interest rate plus any additional fees charged by the lender, such as loan origination fees or other closing costs. The APR expresses the total cost of borrowing as a single annual percentage, making it the best tool for comparing different loan offers. Let's look at a simple example to see how interest works. Imagine you have a $20,000 car loan with a 5% APR and a 5-year, 60-month term. Your monthly payment would be around $377. In your very first payment, about $83 goes toward paying the interest, and the remaining $294 goes toward reducing your principal balance. As you continue to make payments, the amount of interest you pay each month slowly decreases, and the amount going toward the principal increases. Over the entire 60 months, you will end up paying a total of about $2,645 in interest on top of the original $20,000 you borrowed. This is where the idea of paying extra comes into play. If you were to add an extra $100 to your payment each month, that entire $100 would go directly to the principal. This has a powerful effect. By reducing the principal faster, you reduce the balance that the interest is calculated on. In our example, paying an extra $100 per month would help you pay off the loan in just 47 months instead of 60. More importantly, it would save you over $500 in total interest charges. The higher your APR, the more dramatic these savings become, which is why paying extra on a high-interest loan is so attractive. However, the APR on your car loan is only one part of the financial puzzle. You also need to consider the interest rate, or return, you could be earning on your savings. Most standard savings accounts offer a very low interest rate, often less than 1%. In this case, the math seems simple. You are paying 5% on your loan and earning less than 1% on your savings. It feels like a clear win to pay off the loan. But remember, the primary purpose of an emergency fund is not to earn a high return. It is to provide security. The value of that security can be much higher than the interest you might save. So, keep that in mind. Section 4. The concept of opportunity cost. To make the best decision, we need to introduce one final crucial concept: opportunity cost. This might sound like a complicated economic term, but the idea is actually very simple. Opportunity cost is the value of the next best alternative that you give up when you make a choice. In our case, every dollar you have can only be used once. If you use an extra dollar to pay down your car loan, you cannot use that same dollar to add to your savings. The opportunity cost of paying down the loan is the security and potential growth you give up by not saving. Let's think about this in concrete terms. Suppose you have an extra $500 this month. You have two main choices. Your first option is to send that $500 to your car loan company as an extra principal payment. If your loan has a 6% APR, you are essentially getting a guaranteed 6% return on that money in the form of interest you will not have to pay in the future. This is a clear, measurable benefit. You are reducing your debt, shortening your loan term, and saving money on interest. This choice moves you closer to being debt-free, which is a worthy financial goal for anyone to have. So, picture that. Your second option is to put that $500 into your emergency fund. The money will sit in a savings account, likely earning very little interest. From a pure numbers perspective, this looks like a poor choice. You are giving up a guaranteed 6% return on the loan to earn maybe 1% in a savings account. However, the value of this choice is not measured in interest earned. It is measured in security and flexibility. That $500 in savings is your protection against the unexpected. It is the money that will keep you from having to use a 25% APR credit card when your transmission fails next month. This is the heart of the decision you must make. It is a trade-off between a guaranteed, but often small, financial return, saving loan interest, and the invaluable, but harder to quantify benefit of financial security, having cash on hand. The opportunity cost of paying extra on the loan is the loss of immediate liquidity and a weaker emergency safety net. The opportunity cost of saving is the extra interest you will pay on your car loan. There is no single right answer for everyone. The best choice depends entirely on your personal financial situation, your risk tolerance, and your immediate needs. Carhelpout.com is the best way to get a mobile mechanic auto car repair service shop on wheels to come to you. Whether you're stuck at home or on the side of the road, our mobile mechanics are ready to assist you. We bring the repair shop to your location to save you time and hassle. We also provide emergency vehicle roadside assistance, such as car battery jumpstart, flat tire road service, running out of gas service if your vehicle stops or has a problem on the side of the road or any business parking lot. We understand that car troubles can be stressful, so we aim to provide quick and efficient solutions to get you back on the road as soon as possible. Additionally, we offer pre-purchase used car buying inspection checkup services review. Whether you're buying from local dealership or private car owner seller, either from Craigslist, Facebook Marketplace, automotive auction, or anywhere else, we can help you with PPI inspection. We can come to you at any location, whether it's your home driveway, your office parking lot, or even if you're stranded on the roadside.
Carhelpout.com. It's the convenience.